Hi everybody, this is Thomas with the 2018 fourth quarter market review. As you all know, the market took a sharp dive in the fourth quarter. Here's a quick review looking at the chart of the market. This is the S&P for the full year. This dotted line is the beginning of the year, dotted line is the end of the year. Here's a little bit of January. This is the end of 2017. If we draw a line from the beginning of the year to the market top on about October 3rd, that little data box over there says it's 275 days. 192 bars means those are trading days, the weekdays, and it was a gain of 10%. So we were looking good for until October. And then of course we from October 3rd to the New Year's or to Christmas Eve, the 24th, we went down almost exactly 20% with a jagged went down, went sideways, and then had that big December sell-off. And of course, you know that we've rallied about 10% from the bottom. So we are capturing back some of the decline. I wanted to really quickly take a look. There's a spreadsheet that shows the performance of the firm versus the S&P 500. This is the S&P during that October 3rd. From the top to the bottom, there was a decline of about 20% in the S&P 500. The Wynn Capital performance, we had 42 million under management on the 3rd of October. We lost about 3.7 million in assets during that decline, and we ended up with 38 million under management at the end of the decline, and we were down about 9%. Now, we outperformed mainly because only 56% of the firm, client, your accounts are invested in equities. The rest are either in alternative assets, which is gold and real estate. Balanced is a mix of stocks and bonds. And then this is, of course, bonds. This is our cash. And this is what I wanted to talk about, which is the derivatives. So on October 3rd, we had invested about 85,000 in what are derivatives or put options, or what we call the hedge. Now, not all clients and not all portfolios or accounts are hedged. Many accounts and portfolios are very customized due to concentrated positions and unique circumstances of each client. So this is a firm-wide, all portfolios, all accounts. Each individual portfolio of a client is not going to look like this account. But overall, the firm made almost $667,000 on the puts that we own. They went up almost 8 times what they were, and that's what happens when you have a sharp decline like that. And it added 1.5 to the performance of the overall firm. Now, if you take this number versus the equity decline, we mitigated 16% of the decline, which is not bad. It's not great, and all the accounts are different. Some are a quarter hedged, some are fully hedged. They're all over the board. But it just gives a sense that what we're trying to do by making money in a decline did work during that period. Again, lots of disclosures, and your returns will not be exactly what the firm returns were. So let's go back to the report and jump in. This first slide just tells us for the quarter what the major asset classes or types of investments did. US down, developed, international, emerging markets, global real estate, all down. The only thing up were bonds. Since about 40% of the firm client assets are in bonds, that means that instead of going down, there were gains, and that is how diversification works. Bonds often rally during big market declines. And then for context, the average quarterly returns for each of those types of assets, the best quarters, and when that best quarter happened, and the worst quarter, and when that quarter happens, gives us some context about how volatile each of these asset classes are. Then this is looking at longer terms instead of just a quarter that we looked at. This is the 1-year return for those asset classes, 5 years and 10 years. These rolling returns for longer periods give us insight into why we invest. It's 5-year, this particular period, the last 5 years, and the last 10 years includes a very bullish period from 09 to 19. Now, we know from 2000 to 2010, there were actually negative returns in a 10-year period. So rolling returns are negative, but almost all 10-year roll periods are positive, which is why people invest. This is the chart for a quarter, a graph of the performance of the stock market, and it was global stocks, US and everything else were down, and underneath are the headlines associated with that. You can always pause the video if you want to read the headlines and see if you're interested. Now we're zooming out a little bit from a quarter to the 12-month period. That's the big chart, and the news associated with it. And then longer term is this inset chart, which goes from 2000, almost a 20-year chart. And this little highlight is the last 12 months. This is world asset classes, the different categories of investments, from value and small cap, large cap, every type of asset class. You'll see that only bonds had positive returns, and all the other asset classes had negative returns, with Russell 2000, which are smaller stocks, losing the most. Then if we zoom in on US stocks, and out of the whole global world market capitalization, the US is 54%. All the other countries combined are less than our single country. We are still the big gorilla in stock capitalization. And again, small growth was the worst performing type. Large value was the best performing, but everything negative. If we look at international for the quarter, small cap was the worst performing. Value stocks were the best performing, but everything negative. And all of the developed countries altogether are 34% of the globe. The US plus developed, the only one missing is this emerging. 12% are emerging markets. Again, emerging markets have been down much greater than the US over the past several years, but in this particular quarter, they were down, but not down as much. And then if you look by countries, all the developed countries were down. US is in the middle of the pack, Norway at the bottom, and New Zealand the best performing of the losers. And on the other side, a little more volatility with Brazil as a winner and Pakistan as the biggest loser. Commodities, you can see that gold, which we have about a 2% position for people that have accounts that are appropriate to hold a commodity, and that helped also as a diversifier and to offset and mitigate some of the decline. And crude, as the headline showed, had a huge drop during the quarter. Fixed income was positive in the quarter except for corporate bonds and TIPS. TIPS are inflation protected bonds, but bonds did well in the quarter. As the market falls, it's interpreted as a weak economy. The demand for money gets less, and interest rates fall, and bond prices rise. This chart down here is a graphic illustration of that previous chart that showed that the U.S. is the biggest block of world capitalization, and here are all the other countries all together and how small some of them look relative to the U.S. It's basically talking about why we diversify, and if you read the article, you'll see that there are long periods where global stocks do better than the U.S. We're in a period where they're trailing. There's no way of knowing when each category is going to do better than the other, and the way to achieve long-term better returns is to be diversified globally. So we are. This is the second part of that, and then this is one of these little charts that they use that goes by years with each category, and you can see how volatile each category is. Sometimes they're winners, sometimes they're losers, and very, very difficult to predict who's going to be the winner and who's going to be the loser in any particular period. So that is it in a nutshell. Sorry if I went too fast, but you can always stop and take a look at any slide if you want to. I hope you find the summary helpful. And if you have any questions, please give me a call anytime. Alrighty, thanks a lot. Bye-bye.